Yeah, let's take a look at sort of a sales aspect really, and this is a question come from a boot camper who's getting involved in the details as well of mortgages. And one of the issues they're coming across, and this is the title of this little video for you, is they're coming across a price objection. We're talking about price objections. Now, when you're selling any product or service, a customer's always going to be caring about the price. Of course they are. Whether they're going to kick back on it is another issue. This particular friend of mine, he had a problem with remortgages. So let me set the scene for you. Now, remortgage, as we know, of course, is where the customer changes their mortgage from one lender to another. And it's often done to maybe get a lower price or to fix themselves if they think interest rates are going to rise. And that's the problem that my particular client had, because his personal clients had a mortgage with a lender, and it was a set rate of interest. And when he worked out the remortgage costs for him at current rates, it was slightly more. And the customer was balking at the fact that he had to pay more on this remortgage, and he was getting upset about the increase and kicked up a bit and pushed back, and it wasn't very successful. So my friend said to me, how do I overcome, Paul, an objection on price, particularly with a remortgage or something like that, where the customer thinks it's more or it's too expensive, more than they can afford or more they can pay? And it's one of those things where the customer itself is worried about the cost increase, and I can get that totally. And there's a couple of things you can do there, because the thing with objections or reservations is that when they happen at the end of the sales process, it's all a bit too late. You end up in a bit of an angle, bit of an argument, possibly a bit of a ding-dong, and it's too late. Any objections that you think you're going to get when you're advising on mortgages, you should deal with them early. And some ways of dealing with the price objection early are these. The first thing you want to do is have a good old discussion with the client. Let's get a different colour pen here for you. Good old discussion with the client, on interest rates in general. So you want to open up the discussion about interest rates. And here you want to make the point, of course, that we've got a customer there with massive amounts of interest benefits over the last 10 years. I mean, since the financial crash, everybody virtually has enjoyed really low interest rates on their mortgages. And if you wanted to, you could go back into history. 1694 was when they started collecting bank rates in this country. At the time, I think it was 6%. The point is, though, that the last 10 years, we've had the lowest interest rates ever for like 200-300 years. So make the customer aware of that their mortgage that they've currently got is at historically low rates of interest. And that's all going to change, and you can talk about that with your customer. Make them feel and understand that interest rates may well be going up over the next 3 to 4 to 5 years, and they will. Just look at the facts. I'm sure you've looked at it yourself. Take a Brexit, for example. If we have a Brexit deal, which we probably will, I hope we will anyway, then there's going to be an economic bounce. In fact, our Chancellor of the Exchequer said there will be a bounce as soon as the deal is struck. Now, what this means is you've got consumers and you've got businesses who have refrained from spending because of the uncertainty around Brexit will suddenly spend. Businesses especially will start to invest money. Now that, of course, will increase the economy, GDP will increase, and things will start to hot up a bit. Now when economies increase and start to get heated, inflation starts to rise. It always does. Now the government has still given the Bank of England a 2% target. Now with the 2% target of inflation, if it rises above the 2%, then the Bank of England use interest rates to dampen it, which of course they will start to do. Now our interest rates in this country are very low. They should be higher. Quantitative easing has finished now. As a result of that, interest rates will go up. In the States, when they stopped quantitative easing a couple of years ago, they started interest rates going up. And the Fed's rate is 2% at the moment. Ours is, what, 3/4? So historically, we should have a higher rate. There's full employment in this country. Therefore, there's pressure on wages. Amazon announced this week that they're going to pay people the living wage now as opposed to the minimum wage, and that's what, £10.20 or so in London. So all this pressure on wages, companies have to increase their wage bill, therefore they increase their prices, increases inflation, interest rates are going to start to go up. So facts are there. So you need a discussion around interest rates to get the customer thinking about it. And then of course when you provide the data on the remortgage, the customer realises of course that it's going to be a much well, they're going to be paying a higher rate anyway, but they're going to get themselves a good deal. You could talk about the stress rate, of course, that lenders use. 6-7% stress rate. You could work out the numbers on that, which again the remortgage costs look really, really low compared to the stress rate version costs as well. So that helps. The other thing to think about, another idea for you on this, is not so much a discussion on interest rates as well. And this is where there's a small saving. So say, for example, you've done a remortgage for a customer and they're saving themselves, I don't know, £50 per month as a result of it. And you think, well, that's a no-brainer. The customer's going to buy that big time. Of course they are. 50 quid a month. Everyone wants to do that. And you present it to the customer, and the customer says no. And you think, well, why not? It's a no-brainer, And a lot of brokers get really confused about this. But the big issue here, of course, is the customer, if they've got a small saving and they're looking to remortgage, it's hassle, it's change. Now, the problem with that is that customers fear change. Remortgaging to another lender is change. They might be worried about what's going to go on there with their credit scores and all sorts of things, and the paperwork and the admin. And what the customer is thinking is that the change, and that's what they're worried about, of course, the change they're having to go through here, the only benefit for that change is £50 a month, and they might not be bothered with that. So in these instances, you want to talk to the customer very early on about the minimalisation effect of change. You want to talk to them about the fact that you take care of things, you do the paperwork, you deal with all the lenders, the solicitors. In fact, the customer doesn't need to worry about anything. You'll take care of all the change aspects. And as a result of that, you'll have a smooth remortgage process. So make sure you do that if it's a very small saving. The other technique for you to think about here, and this is the best one. We'll talk about dealing with the price objections here. If you think the customer is going to object on price or anything like that, make sure that you qualify them fiercely up front. You must qualify them. Now, when we say qualify, is the customer dead keen to go ahead with you at some point in the future if you give them the right deal? You need to ask them questions about how committed they are early on. If they're balking at a price objection on a remortgage or a small saving, arguably they weren't the right client for you in the first place. So be a little bit choosy as well. Make sure you qualify the customer up front. Qualify. I use MAN, M-A-N. It stands for motivation, ability and need. Does the customer have the motivation to want to remortgage? Are they keen to do it? Do they have the ability, of course, the financial ability? And do they have the need to remortgage? Is their fixed rate coming to an end and they're going to go on to a very high SVR, for example, as a need? So make sure your motivation, ability, need, make sure you qualify them really early on. And if you're in doubt at all as to the client's commitment towards using you, before you've even started, try the reverse psychology. I do it with clients. I say to them sometimes, actually, we've had a good old conversation here, and I'm not totally sure if we're the right fit here. I'm not totally sure if we can do business together. I mean, I'm not right for everybody. Clients, I'm not right for every client, of course, and it may well be that you might be looking for another mortgage broker rather than me. And smile at that point and pause. Now, it's reverse psychology, because what you're doing there is you're telling the client that you're not desperate for business, you're busy, you're good, you can choose clients, and therefore you're giving them the option. They'll come back to you and say, no, hold on, Paul. I'm quite keen actually to do this. I'm quite committed to doing this, and I really want to use you. I think we get on really well. I quite trust you. So that reverse psychology is really quite a powerful little technique which you can do there. And at the end of the day, as a mortgage advisor, you've got to bring home the bacon. You can, you can go and work for a bank where you get a stream of leads, but if you're going to be a mortgage broker of some description, you're going to be good at getting new clients. And if you get new clients, you're going to be good at objection handling, discussions early, change, and then obviously the qualifying aspects as well. So maybe that's given you a few ideas to become an even better mortgage advisor. Bye.